Welcome to the Week in Review, brought to you by Inverse. Investing makes sense when you learn by doing. This week was relatively calm, supported by macro data that looks solid at first glance. Still, savvy investors will want to keep an eye on a few undercurrents. They may prove insignificant, or they may be early signals of stress, like chain smoking, or dressing up as a clown and dancing down public staircases. First up, U.S. employment. On Wednesday, the Bureau of Labor Statistics reported that the U.S. added 130,000 jobs in January. However, the 2025 job numbers were revised sharply lower, from plus 584,000 to plus 181,000. The job numbers in healthcare, social assistance, and federal employment are largely neutral signals. Overall, this report supports the case for the Fed to hold rates, not cut them. In U.S. economy news, Friday the BLS published the January CPI report. Headline inflation was 2.5%, reinforcing the view that inflation is cooling, but not enough to justify a near-term rate cut. Consensus is that the Fed will hold in March, with June still in play. In Canada, there were no major releases this week. The TSX finished slightly higher, up 1.4%. Overseas, deflation concerns continued as China released a January CPI of 0.2%, which was below expectations and down from December. The UK's fourth quarter GDP came in below expectations at 0.1%, and the Eurozone's met expectations at 0.3%. Based on these numbers, it's this analyst's opinion the EU should cut rates to stimulate growth. However, the UK is in a tougher spot, as inflation continues to be persistent. Next, our ongoing earnings report, tracking year-over-year earnings growth from U.S. companies with a market cap over $1 billion. After adding up all the numbers, the earnings growth came to 32%. However, the transportation sector stood out as earnings fell 60%, with individual company results ranging from plus 10% to minus 450%. Even excluding the outliers, the sector's year-over-year growth remains negative, a notable divergence from the broader market. Across the week's releases, a deeper pattern emerges. The U.S. economy is cooling but not cracking, yet the pressure points are shifting. Healthcare added the most jobs while medical services inflation remains elevated, a combination that hints at labor supply constraints, potentially amplified by tighter immigration policy. Financial sector job losses suggest softer credit conditions. Transportation earnings are rolling over. Overseas, growth is weak, and China is flirting with deflation. Taken together, the story beneath the data is of an economy in transition, resilient on the surface, uneven underneath, and increasingly shaped by structural forces rather than cyclical ones. For investors, this is a moment to stay attentive, not fearful, but clear-eyed. Well, that's all for the Week in Review, and remember folks, only when the tide goes out do you discover who's been swimming naked.